This is Scott Hayes, President and CEO of ISC Group. Thought I'd share a brief update with everybody about what's happening today, April 3rd, one day after Liberation Day, when the Trump administration announced their sweeping tariffs on all kinds of imported goods from everywhere. Just thought this might be some timely information to share. Looking back to a long time ago, to March 31, this is a chart showing a history of the average tariff rate on U.S. Goods that are imported for consumption, going all the way back to the Smoot-Hawley era back in the 1930s when tariffs were extremely high, and then where they were today. And then this is their estimate all the way back to March 31st, 2 days before said Liberation Day, where they were anticipating all the economists at JP Morgan that would hover around somewhere around an 8-9% effective rate across the board. Well, fast forward to the press conference yesterday, and here's where they actually landed. And the reason, well, how they got there, near 25%, greater than all the way back to 1904 is the last time the tariffs were this high, was a different way of computing how much we're being charged by foreign countries for goods and services that we import. So this is an interesting chart. It shows that trade-offs, and they call this a line of reciprocity. So effectively, on this y-axis, these are tariffs that we, the United States, have imposed historically before yesterday, and these are the tariffs imposed on the U.S. by foreign countries. So, for example, if you look at India, they have about a 12% tariff on goods coming into the U.S., but they're pretty much an inwardly focused economy. There's not a lot of exports here. So what this is saying is that for it to be even Steven, the U.S. would have to charge the same 12% to them. So this is just the line, and it shows who's above and below the line. So you can see that in all these cases, we are being imposed more tariffs than we're charging countries in return for that. But if you look at what happened with the rate of the tariffs, so the EU is sitting around 2.9%. That's what they charge us on goods that we import there on average. And what President Trump came out with was a 22% tariff that we're going to get them with on goods coming into America. And how they calculated that is a bit of a different method of calculating how you would do a tariff. So what they're saying is that they consider in Europe the value added tax, or VAT, is a very common thing over there. So if there's a 12% VAT tax on anything that you as a Parisian buy, I'm not sure that's what the rate is actually, but say you live in Paris and there's a 12% consumption tax on anything that you buy, that applies to domestically produced as well as imports. Okay, so it applies across the board. Well, they're considering that to be a tariff because it makes our Ford cars, for example, 12% more expensive to somebody buying that same car in France. So based on that calculation, that's how they got up to that really high number. And what that did was it adversely shocked the markets. As I speak, the Nasdaq's down 4% or so. Interestingly, the bond yields are up on this. The short end of the Treasury curve dropped about 19 basis points, 0.19%, because the market's now anticipating that the Fed's going to cut more than they previously had. And the 10-year bond briefly dropped below 4% for the first time in quite a while, but down about 15 basis points as I speak. So it has had some shock effects in the market, to say the least. What everybody anticipates will happen with inflation is that in the short run, the tariffs are inflationary. It's a one-time impact. So the cost of goods is going to go up one time, and then we'll adjust to that. And the rate of change and the rate of future increase should moderate back to normal. So right now, in February, the CPI came in about 2.8%. When you factor in the impact of these tariffs on inflation, that is likely to get up to, according to JP Morgan, closer to 4% than it is to 2%. So above the Fed's stated mandate of 2 to 2.5% inflation rate. Again, that should be somewhat transitory, if you will, because it is a one-time shock. We have seen that the effects of inflation, and auto insurance and shelter has been coming down. So that's going to continue to happen. But core goods is really where you're going to see the impact and the increases in the inflation. So GDP growth, in 2024, the fourth quarter was about 2.4%. All of that was really consumption. Consumers are still spending, and they have been 2.7% in the fourth quarter, and the whole real GDP was 2.4. So everything else in aggregate was slightly negative. So the consumer has remained strong. Now, I think that what you'll see is some acceleration of demand in the short run. So people are going to run out and buy cars, right? If you're in the market for a car, maybe in the next 6 to 12 months, well, they're having a party on the auto lots now because everybody's buying. But we only have about 55 to 60 days worth of inventory of new vehicles here, and so once those run out, higher prices are going to apply. So you might see some acceleration of demand in the short run. But in the longer run, the impact of more expensive goods and services will be to slow the economy, and we may be looking at stagnant, or even JP Morgan has gone from saying 1 to 2% GDP growth in 2025 to the possibility now of a recession, which that wasn't in the forecast before this. So Fed funds and interest rates. We were thinking that they might have 2 to maximum 3 rate cuts in 2025. Now, as of today, the futures market is predicting a greater than 90% chance that the Fed will cut in at their May meeting, and about a 62% chance that they'll cut 4 times in 2025. So that means that interest rates might come down more than was impacted. It just really depends on if the economy does really falter. That would lead to more fiscal stimulus, and lowering rates is one form of monetary stimulus anyway, to help kind of stave off other bad things from happening. So this chart's kind of busy. I've shown it before, but what this is talking about, we think that bonds are relatively attractive right now compared to stocks. This is what's called reflexivity. There's more risk, or there's more good than bad that happens with changes in interest rate. So if you have a 1% decrease in interest rate, not only do you get the coupon of the bond that you're getting, but the bond prices also go up in value. So for example, a 10-year treasury here with no change would be, well, as of yesterday, 4.2%, around 4%. But your total return for holding a 10-year treasury would be 12.1 if interest rates were to go down by 1%. But on the flip side, if rates went up by 1%, well, now your 10-year bonds are less attractive because a new 10-year would pay you more. Your negative return would only be 3.7%. So it's a lopsided risk return payoff in fixed income, and with the relatively attractive yields. You can see on this chart that the gray bar, that's just the range of returns over the last 10 years. The purplish color here, that's what the average was, and then the blue diamond is where we're at today. So across the credit spectrum, you're able to get greater yields still today than average over the last 10 years. Then one other thing I want to touch on is just international. It's been a long-standing trade that U.S. exceptionalism, we've outperformed international stocks, but they're at historically cheap prices right now, even though in the first quarter they had about 1,000 basis points of outperformance versus the U.S. So we finally have seen a pretty wide turn in international, but there's a chance there's a good way to run with that still. So they're historically cheap compared to average against the U.S. They're trading at a significant discount to the U.S. And then we've had things like Europe has decided to have a huge stimulus plan, feeling that they may not have the kind of implicit protection that they've received from the U.S. So even Germany's talking about rebuilding infrastructure and military capabilities and so forth. And so all that is stimulus, and so it should possibly lead to them having a good run of it. And then I thought this slide's also interesting. We're near the end here. But what this shows, everybody, yes, the S&P has greatly outperformed international markets over the last number of years. But if you take out the one exceptional company, the NVIDIA, in terms of what's really driven the performance overall of the S&P 500, really since October 2022, Europe and Japan have been on par with or even exceeding what the S&P 500 has done if you just exclude that one company stock. So it's been a different year. This is the periodic table, we call it. This just shows you the range of returns from best performing asset class to worst performing asset class of all the different categories. And what you see here is that, it's been large cap at the top for a long run. Well, year to date, we've almost flipped this chart upside down. Commodities are doing the best in domestic or developed market equities and so forth. And the large and small company stocks have done towards the bottom. So diversification definitely matters, and matters more now than it has, that you don't have all your eggs in the one basket. And I'll finish with this. This just shows how, average year market returns over a full year. That's the gray bar here. So 2/3 of the time or so it's been up, 34 of the last 45 years to be precise. It's not uncommon to have drawdowns like this. Year to date, we're down a little bit. We were at 4% through the end of March. Now we're back down to 8 or 9 or 10%. So even though this is a bit of a shocker to the system, everything will adjust. Life will go on. We believe that, I don't think I included the slide. Oh, I did include it. Yeah. So over the long run, it's still time in the market that matters, not timing the market. So you have this broad range of possible outcomes over the short run. Stocks have had a range of a 52% to a minus 37% historically over any given year. Over any 10-year rolling period, 20% is the best average 10-year you've done, lost one. And so over time, your range of returns declines, but it's more and more likely that you make money by staying in the market. And the same holds with bonds in the traditional 60-40 portfolio. So I encourage you, just hang in there. Give us a call if you have any questions. We're here to help. Where we add our most value, I think, is when we help our clients from possibly making decisions that could permanently impair their capital. And so staying true to your investment objectives and risk tolerance is really key. And we'll get through it. So with that, thank you, and I'll look forward to talking to you soon.